Hey guys, Chuck Barone here, and welcome to this special weekend video where I'm just going to spend a little bit of time answering some of the questions you guys have sent in your comments section of the blog and my email. You guys have been just amazing about wanting to get yourselves educated and asking me some very good and a lot of times very complex questions. I'm just going to go through a few of these for today to give you guys an idea of what I've been seeing, what people think is important, and hopefully some useful ideas that you can use in your investing, your portfolio, and your saving and building wealth. The first question comes from Craig, and he asks, "Why is the U.S. dollar so strong when the economy is so bad?" Well, Craig, there's several different reasons why the dollar is so strong right now. One of the reasons is, of course, U.S. interest rates are rising. That always strengthens the dollar, especially when other countries like Japan and the Eurozone are keeping their rates so far less than ours. Our Fed overnight rate here is 1.6. In Europe, it's negative. In Japan, it's negative. So that is really holding those currencies down and pushing the value of the U.S. dollar up. That's one of the big reasons. Another reason is people are starting to feel like there's a big recession coming. When that happens, in almost every case, there's what they call the flight to safety, where people from overseas and in foreign countries rush to American assets, the U.S. Treasury market, which of course then drives Treasury rates down, which then adds to the strength of the dollar. So a lot of times the actual strength of the dollar is not related to the actual action in the economy. It's more with the way they measure it, at least on the dollar index, it's more comparative to other currencies than its actual effect in the country and with the goods and services you can buy with that dollar here in the United States. So I hope that gives you a good idea of why the dollar is so strong, at least right now. Number two, a related question: what will cause the dollar to come back down to earth? Well, the reasons I just told you why the dollar is stronger, this big spread between our interest rates and the interest rates overseas. When those interest rates start to get more in parity, and they will, because let's face it, Japan, Europe, and all around the world, they're not immune from this inflation we're suffering from. So ultimately, they will have to raise those rates to bring that inflation down. And when the rates get in parity, that will raise the value of those currencies against the dollar and start to get rebalanced, where the dollar will come down in value against those currencies. So that's what will be watched for, to see the dollar coming back down. Question number 3 comes from Scott. He says, Chuck, I have $20,000 to invest. What should I do with it? I own a $10,000 Series I bond, and I'm sitting on $20,000, can't decide what to do with it. Well, that's a pretty good question, Scott. I'll tell you what I would do. I would probably take a portion of that money and buy gold and silver, a very small portion, maybe 10% of it, $2,000 or so, and invest in metal, just to have as a hedge when the dollar comes down. I would take a portion of that money and invest in dividend-paying, blue-chip consumer non-durables like soap, food, defense. I think that I like preferred stocks. I know they're kind of an odd investment for most people. Preferred are a little bit different because, unlike with a common stock, you don't vote, so you lose your proxy card once a year for the stocks you own. But they pay a much bigger dividend yield. I saw a JP Morgan preferred that has a 6% dividend yield. Now, they're always going to pay their preferred dividends before common dividends. And because of that, the preferred stock price is much more stable. It moves more like a bond even than a regular common stock does, which is more driven by earnings. So I like preferred stocks. I like dividend-paying stuff. I like utilities, especially in this environment right now. It's not the time to reach for growth. You want to protect the money you have. So I would have maybe 30% or 40% of my portfolio in those dividend-paying stocks, and the rest in either I have short-term treasuries, nothing longer than 2 years, or even some money parked in cash in a money market. I'd be playing it conservative right now. The idea being to preserve your money more than to be reaching for gains right now. When the storm passes and the recession's over and the damage is done, everything's going to look like it's on sale compared to the prices we're paying now. So keep some powder dry, and when the time comes, there's going to be plenty of places to put that money where you'll have a much better opportunity for bigger gains. There's another good question. Hi, Chuck. What are your take on I-bonds? Now, if you guys haven't heard of this is a new treasury that they're offering. And it pays, I think right now, it's inflation adjusted. I think right now the dividend on it, or the yield on it, is 9 or 9.5%. So it's really juicy. It's super secure because it's a U.S. Treasury. So it's backed by the full faith and credit of the United States government. It has 9.5% is a pretty nice yield with the very, very minimum of risk. The only issue with these bonds is they're limited in how much they allow you to invest. I think the maximum is $10,000 per person. So, if you don't own one of these and you have some money to invest that you can put away for a little while, I-bonds are a great idea right now. I don't see the stock market returning 9.5%. You're not going to get that in the bond market. You're not going to, it's going to be hard to find a place for the next couple of years where you're going to be able to earn that kind of return. So those are a great idea right now. Next question is, hey Chuck, so the big market drop hasn't happened yet? Well, I did a little bit of research about recessions and how they work. Actually, a lot of research on it. And especially a little bit different because this is a recession coupled with inflation. So this is a little bit more rare a phenomenon than a general regular recession, or even a big real estate crash like we had in 2008. According to the research I've done, when you have a recession combined with inflation, the average duration of that recession is about 20 months. Now that's average, so say between 16 and 24 months roughly, the recession will last. And the average decline in the S&P 500 is 40%. So average, let's say, between 30 and 50% decline from the high. So I'm looking for something roughly similar to that for this recession. So we know that we had a negative GDP in the first quarter. We're pretty sure we're going to have a negative GDP coming up here in the second quarter when they report it. The second quarter ended at the end of June. They're going to report it toward the end of this month. I think that when that report comes out, it'll show that it's the second consecutive month of negative GDP. We will have our confirmation that we're already in a recession. So we're probably 6 months, 7 months into this recession already. So figure we probably have somewhere between a year to a year and a half to go before this recession ends. Right now, the S&P 500 is down roughly 20% this year. So I would expect it to go down roughly another 20% from its peak. So I think we have some room still to the downside during this recession. I don't think we're going to see this giant falling off a cliff of it. I think it's just going to be a slow grinding down, especially when you have so much intervention in the markets, with some of these buyers showing up who are mystery buyers that doing things that don't really make sense in a bear market. So figure you probably have 20% more of the high value. So say, I think the high on the S&P was around 4,000, so probably have another 800 points roughly to go down before the recession's over or so. So look for these numbers. And again, this is plus or minus. We're just going by the averages of recessions with inflation. But we still have a ways to go on this. We're just getting started. So it's again, as I've been saying in every video we've put out, prepare yourself for this. Prepare your portfolio for this. Save your money. Start building up your emergency fund, your FU fund, your protection fund. Try to build that up to $25,000. You'll be glad you did. My mentor, who taught me this and drilled this into my head a bajillion times, he explained the reason why, and it's smart. He said, Chuck, if you're living your life correctly, you should never have a problem or situation that this $25,000 won't get you through. And in my long life, I'm already getting kind of old here, guys, I found that to be absolutely the truth. One last question before we wrap it up here today. He said, hi, Chuck. What's the point of saving 10% of your income if I only make $1,200 every 2 weeks? That's only a measly $120. Why not save 50%? That's a great question. First of all, most people are not able to save that much of their income. They have, bills, they have houses, rents, they have kids, they have cars, they have insurance, they have cell phones and internet and a bajillion other bills. It's hard to save 50% of your income. The reason we use the 10% number is that's a number that most people can do without a change or a dramatic change in their lifestyle. The idea here is not to live a miserly life and to save money at the expense of having a good and fun and enjoyable life. If you can save 10% of your income, then you can enjoy spending the rest because you're living within your means. So depending on your income, after you pay your bills and save your 10% first, the disposable money you have left, enjoy your life. Go to dinner, travel, take a vacation, do something special for your kids. That's what the good things in life are. If you're saving your 10%, you're doing things properly. And if you can save more of that, if you don't spend all of the rest of your disposable income and you can save more, bully for you. But the idea is to have some equilibrium in your life where you're saving money at the same time you're living the same enjoyable lifestyle you're living as you were living when you weren't saving your money so much. Anyway, the last thing I want to read was a good question, and I hope this information is useful to you guys. The last question is, he said, hey Chuck, do you have an email to write to you rather than just posting in the comment section? We do. And we started this up, and the response has been crazy. The email address is askchuckbarone@gmail.com. askchuckbarone@gmail.com. If you have a question that's a little more in-depth, a little more specific, a little more personal that you don't want to put in the comment section, this is the place to email me and to ask questions. Now, please be patient with me. Since we put this out, I probably had 300 emails. The questions are not, hey Chuck, what do you think about silver? They're very, very in-depth. So it's taking me a little more time to get through those questions because I want to have those answers be thoughtful, well thought out, not just whip out an answer to be done with it. So be patient. I will get to every single email you guys sent me. And that's it for this session. I hope you found these questions maybe similar to some of the questions you might have. These are very common questions I get asked a lot. If you want to follow up, askchuckbarone@gmail.com. We'll be back on Monday with the report and a new little education lesson for everybody. Have a great weekend, everybody, and we'll see you on Monday. Thanks.